The real estate rebound in the United States has our next guest moving from residential to commercial properties in his distressed asset funds. For a look at the U.S. real estate markets, we're joined by Steve Hagenbuckle, founder and managing principal, TerraCap Management. He joins us from New York. Good morning, Steve. You invest in distressed properties. As we just said in the intro, you shifting to commercial from residential. Why that shift? What happened in the residential market that's moving you a little bit further away from it?
Well, we actually participated in the residential market between 2009 and 2011 as buyers. We are now exiting those investments at nice returns. The best time to buy residential was 2009 to 11, and right now we're taking profits, and commercial follows residential, so we're focused on commercial now.
So when we say commercial, what exactly? I mean, it's such a broad sweeping phrase. Where do you like commercial?
Commercial is broad sweeping, very good point. We focus on mainstream commercial properties, so select service hospitality or hotels. We like offices. We like apartment buildings. We like flex, light industrial, those types of products. And the focus is distressed situations, not distressed buildings. Results of over-levered borrowers who are going through deleveraging right now and forced selling as required by the banks.
Just because I want to dig further into the commercial strategy, but on the residential strategy, are there still some pockets of interest on the residential side? The best time, as you said, was 2009, 2010, but there are some still pretty depressed markets out there.
There are depressed markets. The key driver for all real estate demand, residential and commercial, is where is the population growth sustained. So we would suggest focus on areas of sustained population growth where there's some land constraints. So you might want to focus on Florida. We love Canadians. Canadians love Florida. That's a good target. However, I would say that now you're going to see less appreciation uprides in residential than what we've seen in the last 24 months.
I'm curious, you use the phrase shadow tenants when you're looking at commercial properties, saying that there's pent-up demand for shadow tenants for commercial real estate. What exactly is shadow tenant?
Right. Shadow tenancy is a term that we came up with at TerraCap, and what that means is there are quite a few would-be tenants that are interested in going into specific buildings and locations, but are hesitant or reluctant if that building is part of a distressed situation. So, for example, if a lender owns the building or if the borrower is going through the default and foreclosure process, it's very rare that a tenant is willing to sign a lease with a lender or a borrower who's in foreclosure. So they sit on the sidelines waiting for solid buyers like TerraCap to come in, acquire the property, take care of deferred maintenance, be in a position to fund tenant improvements, and when they see that, all these tenants come forward and are quickly signing leases with very limited efforts on our part. Now, the reason for that is there's been literally anemic to hardly any new speculative commercial construction going on in most pockets of the United States, especially the areas that we like are the secondary markets where the larger players can't compete because they need to put too much money to work, and that's what shadow tenancy is all about.
Steve, where are those secondary markets?
The markets that we like that have the best factors coming into play, meaning sustained population growth, land constraints, also where we can acquire properties at 30 to 50% of replacement cost, and new properties are relatively young, meaning less than 10 years old, would be in areas such as Naples, Florida,
yes.
Sarasota, Florida, parts of Orlando, all the places that Canadians hate to come and visit and buy.
Sorry, Steve, I actually go to Naples a lot on the residential side, not on the commercial side. It's actually been a pretty firm market just shopping around, which leads me to the next question. So those are the locations, but what type of commercial real estate are you looking at?
Well, we talked about this a little earlier. We look at Class B, B+, office buildings that are part of a distressed situation, maybe completely vacant but in a good location, or maybe 50% occupied. I'll give you an example. If you know that area, you usually fly in to Fort Myers International Airport. That airport takes in about 7.8 million passengers a year. very close to the airport, about a mile and a half away, we acquired in our first phase 7 buildings, 230,000 combined square feet. It was 55% occupied when we bought it. It's now, 5 months later, 85% occupied. We increased the gross revenues in that property set by about $380,000 a year, which at a 10 cap is about $3.8 million in increased value just there. And then we went ahead and just bought another 4 buildings, or another 110,000 square feet to add to that portfolio, positioning it more as an institutional exit for us.
I understand you're staying away from retail properties, though. Is that regionally a regional emphasis, or is it right across the board, and why?
Well, the answer to both is regionally. In some areas, there's been some overbuilding in retail, clearly. Some larger super centers or destination centers, if you will, walking town center activity centers, meaning malls that are, 1.2 million square feet in size or bigger. Those have pulled a lot of the tenants out of the smaller strip centers. So those areas we would stay away unless it was a big box type of scenario draw with a small strip center sharing an entry. But across the country, retail in general was overbuilt, but there are areas that are still good for retail. We think right now owning larger retail, these activity centers or destination centers, is a better play than some of the smaller centers that have suffered as a result of these larger ones being built.
And finally, Steve, because it's distressed properties that we started the discussion with, and the emphasis, we've talked to a lot of people who've been buying residential properties, and they say they're on the courthouse steps, in fact, in the way they're buying these houses one at a time and refurbishing them, etc. How difficult is the acquisition of distressed properties? I know commercial's different, but is it difficult? Is it a lengthy legal process? How do you go about it?
It's not as bad as you would think if you know what you're doing. I mean, we even buy notes from the banks, and then we do friendly deeds in lieu of foreclosure, ultimately to get to the equity or the asset, which is, the underlying collateral is what we want. We want to own the buildings. It's not as challenging. I think people are intimidated by the term of, taking over a note and doing a friendly foreclosure process. If you have a good legal team in place, this stuff can be done in as quick as 2 to 4 weeks. And if you have a willing borrower who's giving the property back to you in return for being released from their guarantees, it usually goes very smooth because you've just basically brought them a nice Christmas gift by releasing them of X amount of millions of dollars in personal guarantees.
Interesting conversation this morning, Steve. Thanks very much for joining us.
You're very welcome. Thanks for having me.
Steve Hagenbuckle, he's founder and managing principal at TerraCap Management, and he joined us from New York.